Thank you very much, Lars. I'm very excited to be here. Let me share my screen here with you. So, this paper is titled "The U.S. Public Debt Valuation Puzzle." Let me start by thanking the organizers, Miriam, Lars, Eric, Valentine, Mike, for doing this. I think this is a great initiative. We all need to be experimenting with new ways to present our work, and so I'm really glad that they're doing this. I'm glad to be part of this. This is joint work with Zhengyang Jiang, Stijn Van Nieuwerburgh, and Mindy Z. Xiaolan. I wanted to point out that Zhengyang and Stijn have independent work on related topics related to fiscal issues, and Mindy's done quite a bit of work in the area of macro finance as well, particularly on the labor share. So this paper is about the public debt valuation puzzle, and what we're going to try and sort of do in this paper is think about what happens when, instead of sort of focusing on pricing individual bonds issued by the US government, we're going to try to price the whole portfolio. And when you do that, that brings in a whole new set of restrictions that this literature has pretty much ignored. And we're going to get some important insights, we think, from doing that. Okay. But before I do that, I want to take a minute or two to put this in the broader context of what's going on in the world today. As you probably know, the US federal government, much like other governments around the world, has launched into a pretty radical fiscal stimulus. The federal government deficit for 2020 is now projected to be around 4.28 trillion. That's about 19% of projected US 2020 GDP. That puts the US somewhere in the mid-range if you look at OECD countries. Where does that number come from? There was about a $1 trillion deficit that was already projected before all of this started. The deterioration in the economy automatically triggers a number of adjustments in the budget that are responsible for about 600 billion. But then, of course, there is the 2.2 trillion due to the CARES Act that was passed a couple of weeks ago by Congress. And then yesterday, there was a new bill signed by the House, sent to the president to be signed, that adds about another $500 billion. So if you add all that up, that adds up to about 4.28 trillion. Even before all of this started, of course, the US federal government, which will be the focus of our talk, is the largest borrower in the world. Outstanding debt held by the public today, according to the latest report by the Treasury for March, that number is going to change quickly, of course, is already 17.7 trillion. So that doubled as a fraction of GDP from about 35% before the Great Recession to about 80% in 2019. And according to CBO and CFRB forecasts, it's forecast to grow well in excess of 100% of GDP. This projection right here excludes the bill that was passed yesterday, so you probably want to add a couple of percent to those projections. If you look at the broader time series, what you see, of course, not surprisingly, is that the federal government ran up a large amount of debt during the Second World War. As it came out of the Second World War, it was helped by a fairly high growth rate to reduce the debt to GDP number. And for a brief while, it ran some surpluses. The bottom black line plots the annual deficit as a percent of GDP for the federal government. What's striking is that if you want to sort of go back to the last time the federal government was running surpluses, you have to go back to the late 90s. So that's back when I was still in graduate school and Michael Jordan was still playing basketball. So the federal government has been running deficits consistently for the past couple of decades, even prior to the onset of the crisis. But of course, the COVID-19 pandemic is going to lead to a dramatic run-up in the size of these deficits. And that raises some interesting questions, right? We don't really know how long this crisis will last. I guess a lot of that depends on what happens when we gradually relax social distancing measures. But in the absence of a vaccine, this crisis could easily last for more than a year, perhaps a couple of years. And right now, it seems like the federal government spending decisions seem based roughly on a short pause scenario. That is, the economy is sort of in freeze status because people were forced to stay at home, but once those measures are relaxed, the economy will sort of resume. But it's not clear that that's the right scenario, obviously, and that, I think, raises a key question for policymakers and for us, which is, do we think that the federal government can easily borrow trillions more? It seems like right now, that's sort of the way Washington, D.C. is thinking. We can borrow more to fund the private sector's payroll, to bail out states. That is becoming a huge issue that I'm sure you've heard about. A lot of states have dramatically underfunded pension plans, but on top of that, they're running out of money to fund their unemployment insurance programs. And the federal government might be called upon to do lots of other things in the near future. It's not entirely implausible that at some point, for example, the financial sector will be severely impaired and some banks might have to be bailed out. So the question that I'd like to put to you as well, using a poll, is, do you think the federal government can easily borrow trillions more? Or do you think the federal government should start thinking about reducing the deficit? And I'd like to call on Valentine to launch the poll, because I think it'd be sort of interesting to see, to get a sense of what people think about this, this question.
Hi everybody. So you can vote on this poll, or express your opinion by going to the link that appears on top of your screen, and that's been also copy pasted to you in the chat. And you can open this in any browser and just let us know what you think. Thank you.
Hanno, I think we're converging very close here, so you can take it from here, I think.
Okay, thank you. So this is really interesting. I think we're sort of, it's very close. I think we're sort of in a roughly 50-50 split. So half of this audience of macro financial economists think that we can. I'm going to share my screen again. We can borrow a lot more. but the other half seems to think not. Okay, so let me go back to share my screen with you. All right. Sorry about that. It seems like okay, here we go. So one answer that's sort of out there and has been formulated most forcefully by Blanchard is that, well, there may be no fiscal cost for a country like the US. And his reasoning, put simply, this doesn't quite do justice to it, is that, well, historically, if you look at the US experience, the short-term interest rate, which I plotted here, it's the nominal T-bill rate, the 3-month T-bill rate plotted against the nominal growth rate of GDP. The nominal T-bill rate has consistently been lower than the nominal growth rate of GDP. And the reasoning then is that the government could quite simply roll over the entire public debt every 3 months at this T-bill rate, and the debt to GDP ratio would actually be drifting down over time if you ran zero surpluses. So that leads him to say that there may be no fiscal costs. Of course, there are a few episodes where the T-bill rate actually is not lower than the GDP growth rate. And I think we are about to enter a period like that. But we want to take Blanchard's sort of claim and examine it more closely, because we don't quite think that this holds water. So that's going to be what we are going to focus on. Is this the right way to think about this issue? And we think maybe not. So what we want to do instead is go back to the basics. That is to say, let's go back to thinking about the government's budget constraint. And what you have on the top of the slide here is the one-period budget constraint of the government. It basically says that the government has, on the left-hand side, some spending needs today. And then on the right-hand side, it has T, tax revenue, that it can use to finance its spending. But it can also issue new bonds. So QT denotes the number of new bonds that it is going to auction off and sell. And to keep it simple, we have zero coupon bonds here. So the H superscript refers to a zero coupon bond with a maturity of 8 years. So for example, when H is 5, you're going to pay back 5 years from now. Okay. QT minus 1, that's of course what you're carrying over from last year. That's the value of the outstanding, or the quantity of outstanding bonds carrying over from last year. What we're going to do is we're going to take this equation and then just basically apply no arbitrage bond pricing. That is, we're going to say, look, you know, the price of a 5-year bond today is going to be the properly discounted value of a 4-year bond at the end of next year. We're going to apply all these no arbitrage bond pricing conditions and then just iterate forward on this budget constraint. What that iterative process gives you then is an expression for the value of the federal government's outstanding debt. This is the entire portfolio of treasuries, okay? So that's important. That's going to be the focus of our paper. And it says, well, the value of outstanding debt has to be equal to the properly discounted value of all future primary surpluses. So primary means you're excluding interest payments. So T minus G denotes primary surplus. And then there's this sort of nuisance term at the end, which is the discounted value of outstanding debt, cap T periods from now. We're going to impose a no bubble condition, which says that that value, when discounted back to today, has to go to 0. I will point out, as I'm sure some of you realize that there are models in macro that actually imply violations of this condition. However, most of these models do not feature long-lived investors, and typically these violations would disappear if you have long-lived investors. But that is a key restriction that we will impose on this exercise. Okay, so now we're ready to actually go forward and use this equation, and sort of, you can think about it as the government's intertemporal budget constraint, or you could think about it as just a valuation equation for the government's portfolio of outstanding securities, okay? You could think about it both ways. It has to hold ex ante in nominal and real terms. You're probably thinking, wait a minute, surprise inflation can help the government. That's true ex post. But ex ante, this equation is what it is, and surprise inflation doesn't really change any of this. You can allow for default, by the way. That's not going to change the right-hand side of this equation, as we show in the paper. You can think about default as nodes where the present discounted value of surpluses is actually zero going forward. And so in some sense, that's not going to change the right-hand side of this equation. So what's central here is that we have the Treasury's sort of balance sheet where on the liability side, you have the spending commitments. And so you're going to have the price of a claim to all spending. You have the value of debt, okay, because you promised to make all these debt payments as well. And then on the asset side, you have the revenue claim. And then you can sort of do Miller-Modigliani for the Treasury and think about, well, what's the connection between the riskiness of these different claims? And there's some really strict restrictions that are imposed by Miller-Modigliani logic here, right? In particular, if you think about the risk premium on the entire outstanding portfolio of Treasuries, then it has to be true that that reflects, on the one hand, the riskiness of the claim to taxes. That's the first term on the right-hand side, because you're going long in that claim. And then you're taking a smaller short position in the spending claim, okay? And so the riskiness of these two claims is going to determine the risk premium on Treasury portfolios, regardless of the maturity choices the government makes, regardless of the financial engineering going on in the background. What the Miller-Modigliani logic dictates is that ultimately the risk premium, the riskiness of the entire portfolio, is pinned down by the risk characteristics of the tax claim and the spending claim. And so you could rewrite it in terms of betas to say, look, you know, the beta of the debt claim is going to be determined by the beta of the tax claim and the beta of the spending claim. All right. It turns out in US data, when you compute the average excess return on the entire Treasury portfolio in excess of, say, T-bills, it's about 100 basis points per annum over a long sample that starts after the end of the Second World War. That number is flattered by a secular decline in long-term interest rates. It's not clear that an investor in the 1980s would have expected that, and so I think that that is probably an overestimate of the true expected return. Basically, the returns on the Treasury portfolio are pretty low. So it's kind of nice to think about a benchmark where you say, look, you know, let's suppose that the entire portfolio is risk-free. What would that imply? Well, if you set that excess return to zero, you can solve for the beta of the tax claim, and it has to be quite a bit smaller than the beta of the spending claim. So the tax claim has to be safer than the spending claim to keep the debt close to risk-free, is what this is saying. And the more debt you have outstanding, B here is the value of debt excluding the current surplus, the more debt you have, the safer the tax claim has to be. That's sort of what the return evidence pushes you towards. But when you look at the cash flow evidence, this is kind of the key to the puzzle, you actually get a fairly different picture, because if you look at the cash flows, they actually look pretty darn risky. Primary surpluses go down dramatically in bad times, in high margin utility times, like, for example, the period we are going through now. And I want to point out here that this is not just some abstract exercise, right? Because you might think, well, how is this relevant? Well, if you were an investor who was consistently buying all of the treasuries that are being auctioned off and you just hold until maturity, that primary surplus, that is literally the cash flow on your investment strategy. So there is definitely a very direct mapping to an actual investment strategy that we are considering. This is not just some abstract exercise. And so just looking at this bottom chart here, where the shaded areas are recessions and the gap between the two lines is the primary surplus as a fraction of GDP for the US federal government, what you'd be inclined to think is, oh, well, I would think that the beta of the tax claim is got to be much higher than the beta of the spending claim. But remember, if that was true, then the entire portfolio would be extremely risky. Okay, so that's the tension that we want to talk about in our talk today. And just to summarize it, let's go back to that debt valuation equation, where you're writing valuation of debt as a by discounting future primary surpluses. You could sort of say, well, let's do sort of the naive thing, which actually a large fraction of the literature on this does, and says, let's just price everything off of the risk-free Treasury yield curve. That's the first term you see here on the right-hand side, where you're sort of abstracting from the covariance between primary surpluses and the pricing kernel. That in the data, that first term is actually going to be small because the federal government is projected to run small surpluses and has been throughout the post-war history. But the covariance terms critically make matters worse. They're going to push the value of the Treasury portfolio down because the tax claim seems to be quite risky. Remember, taxes as a fraction of GDP plummet in recessions, as I'm sure we're going to see now. The government is going to collect, as a fraction of GDP, much fewer dollars in tax revenue. But on the other hand, it's spending a lot more. So the covariances push you in the wrong direction. And at the end of the day, are going to lower the left-hand side of this equation, okay? And so what you're going to end up with is sort of this puzzling conclusion that the actual value as dictated by the market of the Treasury portfolio seems much bigger than what one would get if you were to value this portfolio based on the actual fundamentals, okay? So in some sense, you're going to say, look, it looks like the risk-adjusted interest rate on these surplus claims that the market is using is just too low, okay? Most of the macro fiscal literature doesn't think about this, and there's some recent exceptions to that. For example, there's a nice paper by Lucas Schmidt and Amir Yaron that actually tries to think about this a bit more, okay? Before I dive into the actual details of the model, let me sort of, in broad strokes related to the literature, there's obviously a huge literature on bond pricing, on dynamic term structure models. What's kind of interesting is that that literature has put an enormous amount of effort into pricing individual bond securities, but for the most part, it has not tried to price the entire portfolio. And what we are saying is, look, if you do that, you're bringing in a whole new set of no arbitrage restrictions that have been ignored. This paper is going to make superficial contact with the literature on optimal fiscal policy. We're not going to drive optimal fiscal policy, but I do think that we're bringing out new issues that this literature ought to focus on. Most of this literature doesn't really take the asset pricing moment seriously. And in an environment where essentially investors are sort of risk neutral, what we're talking about doesn't really matter very much. But of course, that's not the world we live in. Okay, and we want to argue, look, these trade-offs between ensuring bondholders and taxpayers are real, and you can't just ignore these, okay? There is also a large literature on fiscal sustainability, which assumes that the debt is risk-free and then tests the intertemporal budget constraint, okay? So that literature suffers from sort of a joint hypothesis problem, because they're assuming debt is risk-free and then testing the intertemporal budget constraint, but you can't really do that because it doesn't look like these surpluses should be priced off of the risk-free rate. There are exceptions to this. Very nice recent paper by Mike and Lucas with Andres Schneider, and another paper by Payar and Ren recently that have tried to address this. Okay, so let me actually, at this point, give you a bit of a roadmap for where we're going. I want to briefly sketch a few theoretical results before we dive into the mechanics of the model, and then hopefully get to sort of the meat of the paper and the conclusion pretty quickly, okay? All right. So first, I want to briefly highlight sort of the key force in pricing a claim to primary surpluses. And so to do that, let's think about strips that only pay off tax revenues, say 5 or 10 years from now. So they're like zero coupon bonds, but for risky claims which pay off either tax revenue or government spending strips. And what you can show, and this is actually not really our result, this is just drawing on the literature, particularly on a very nice paper by Backus, Boyashenko, and Chernoff. We're going to show that if you assume that spending is cointegrated with GDP and that taxes is cointegrated with GDP, which we will, then what you get is that the long-run discount rate for the spending strip and for the tax revenue strip is going to be equal to the long-run discount rate for GDP strips. And that's not too surprising, right? Because in the long run, really the only risk you're exposed to is GDP risk. And so you're going to price all these claims in the same way. Now, of course, importantly, the long-run discount rate for GDP strips is going to be much higher in a reasonable model than the long end of the risk-free yield curve, okay? Why do we know that? Well, we know that from work by Hansen, Scheintman, Borovichkin, Scheintman, and others, which shows that there's a big permanent component of the pricing kernel that drives the wedge between sort of the equity premium and the long-run bond yield curve. This already tells you that we're going to have to fight, if we want to sort of price government bonds, we're going to have to fight this force, because in the long run, the discount rates you use for primary surpluses are going to be much higher than the discount rates, the long-run discount rate that you get off of the Treasury yield curve. Okay, that already illustrates some of the tension if we have sort of cointegration, which we're going to use. Okay, so what's going to happen in our model? And I wanted to briefly preview this before we jump into the details, is that if you plot the risk premium on these spending claims, and so I have here these risk premia plotted against the maturity for G claim, T claim, equity claim, and GDP claim, you see that in the long run, the G and the T claim, as you'd expect, are priced the same way GDP is, okay? And that's this cointegration relation that's driving things. But in the short run, which is also what you'd expect, the G claim is actually quite a bit safer, right? Well, that's because, you know, as a fraction of GDP, government spending goes up in bad times. And that's where that action at the long end comes from. Now, to keep the debt risk-free, the government is going to have to fight this, right? Because remember, if you want to keep the debt risk-free, it's going to have to offset this long-run force, which says, well, you're going to have high discount rates applied at the long end. And the only way it could do that is by having a severely pro-cyclical tax policy where you increase taxes in bad times, which is obviously not what the government does. Okay, so just to summarize, the short-run discount rates are higher for T than for G, but government debt investors have a net long position in a claim that's exposed to the same cash flow risk as GDP. And so if you put all this together, you end up with the conclusion that the entire claim is actually going to be pretty risky. All these Treasury securities put together are going to be pretty risky, which is obviously counterfactual. So that's the tension we're going to have to struggle with in this exercise. Okay, so now I think we have sort of all the elements on the table for us to be able to jump into the nitty-gritty details. We're going to look at the federal government tax revenue and spending, excluding interest expenses. When we're doing this, we're integrating essentially the Treasury and Social Security Administration. So the bonds that are held by Social Security Administration, those are netted out in our exercise. Okay, we're going to find tau as the log of the tax GDP ratio, and G is the log of the spending GDP ratio. We're going to allow delta tau and delta G to depend on lagged macro variables, but importantly, they're also going to depend on the level of tau and the level of G, because we're going to allow for an error correction mechanism to drive the ratio of spending to GDP and the ratio of taxes to GDP always back to its long run mean. That's basically what cointegration means here. Okay. So as we said, we're imposing the tax revenue and spending are co-integrated, and I'll point out to you in a second that in doing so, we're actually being conservative. Okay. We have two co-integration relations, one between tax revenue and GDP, one between spending and GDP. And so fiscal shocks are only going to temporarily affect the level of tau and G. Okay. But in the long run, you're always going to go back to that relation. Okay. And so just to summarize, the cash flow dynamics are summarized in this state vector Z, which includes inflation pi x GDP growth. It includes the short rate on treasuries, includes a term spread, a price dividend ratio, because we're also going to price cash flow risk, dividend growth, the growth rate in the tax GDP ratio, the growth rate in the spending GDP ratio, and then you also have to include the levels to enforce this co-integration relation. We're going to estimate these state variable dynamics just by OLS on the post-war sample, and actually we've extended the data to 2019, so I should have updated that. Okay, so now we're pretty much off to the races, and I can sort of show you what these responses, impulse responses look like that we've estimated. So the left panels, the three left panels show you the response of a tax over GDP to a output growth shock in the first row. In the second row, we're looking at a tax shock. And in the last row, we're looking at a spending shock. Note that imposing co-integration radically changes these impulse responses, right? We're forcing these impulse responses to go back to zero in the long run. There's very little evidence of sort of S-shaped dynamics here. What you see is that a tax shock temporarily increases the surplus. Surpluses are plotted in the last column. Okay, so the last column shows you sort of the total effect on the surplus as a fraction of GDP. And as you see, there's very little evidence of sort of S-shaped dynamics or overshooting. It's not the case that when the government runs big deficits today, it's sort of offsetting that by running bigger surpluses in the future. We find little evidence for that. One thing that people have told us, particularly John Cochran has pointed this out, is that he says it's critical to condition on the value of debt today as a fraction of GDP. When we do that, we actually get pretty similar results. So even though we don't, in our benchmark model, include the debt to GDP ratio and the state's pace, that doesn't seem to matter very much. Okay, I'm gonna have to pick up the pace a little bit. What I want to show you here is a plot on the left for tau, for delta log tau, on the right for delta log G of 1 year, 5 year, and 10-year forecasts. The red dashed line is our VAR. The yellow dotted line is the OLS. So that's the best linear predictor. We sort of know that over longer horizons, our VAR, because it imposes restrictions, is going to do a little bit worse. But the takeaway here seems to be that actually our VAR, even when you go out 10 years, both in terms of forecasting spending and taxes, seems to do a reasonable job at it. So that sort of gives us some comfort that this is a fairly reasonable model to be working with in forecasting primary surpluses, and that's obviously going to be key in driving our results. Okay, so then to conclude the model part, what we do is we specify a flexible, dynamic model that imposes no arbitrage restrictions. Basically, we're going to use Ang and Piazzesi 2003, a model that I think most of you are familiar with, where you're saying that the risk prices also have an affine structure in the state variable. And then we're going to estimate these risk prices in the lambda matrix to match a whole bunch of moments for bond yields, price dividend ratios, and expected returns on stocks and bonds. Okay, so that's where we're going to get all the risk prices from. I'm not going to have time to go into too much detail on exactly how we do this, but suffice it to say that I think we do a reasonable job of matching the dynamics of yields, price dividend ratios, and matching the moments of returns that we wanted to match. Okay, so now we're actually kind of ready to go here. We're going to say, look, we have an affine expression for the price dividend ratio on the tax claim, the price dividend ratio on the spending claim. That's affine in the state variable. And so if you use that bottom equation, you're going to get an expression for the model predicted value of debt to GDP. Okay. We're going to start with the model with cointegration, but I'll show you how cointegration matters here in a second. These are valuation ratios for the T and the G claim. The risk premia are actually surprisingly similar for the T and the G claim in this benchmark calibration. That's because even though the G claim is a lot safer at the short end, it sort of becomes a little bit riskier at the long end. But you know we're in trouble here, because what I told you at the beginning is in order to sort of have close to risk-free debt, the tax claim has to be a lot safer than the spending claim. And clearly there's no evidence for that from our model, our baseline model, or any of the other models that we've estimated. And that's why when you back out the market value of debt as a fraction of GDP, you actually end up with a big wedge between the actual value of government debt outstanding, which is computed just by adding up all the market values of all the bonds outstanding. We did this very carefully following methodology outlined by Hall and Sargent. And the average gap between what the model says debt is worth and what the market says is about 2.57 times GDP. So it's a huge gap. It's actually fairly small prior to 1980, but what you really notice is that in the last 3 decades, the gap just completely explodes, and it's grown 5-fold. And I'll talk a little bit about why that is in a second. Okay. First off, we're being conservative by imposing cointegration in the following sense. If you don't impose cointegration, then actually the T claim is permanently riskier than the G claim. So these again are these discount rates plotted against maturities for strips. And if you don't impose cointegration, you don't impose that all these claims are equally risky as GDP. This actually would make the puzzle much worse. I'm not going to show you the numbers, but if you do it this way, the wedge is an order of magnitude larger. So clearly, in that sense, we are actually being somewhat conservative. Our model, as I said, has sort of this convergence of long-run discount rates, which we think is pretty reasonable. Okay, so this is a bit of a head scratcher, and then you think, well, where do you go from here? So my office is next to Arvind Krishnamurthy's office, and so one thing you start thinking about is, well, boy, it sure seems like the Treasury is able to sell these securities at prices that are potentially higher than what another issuer would sell them for. And so if you let lambda denote sort of the gap between the price that the Treasury can sell these securities for and the price that another entity promising the same cash flows would sell them for, you can call that a convenience yield, then what you get is that debt potentially reflects one additional term, which is sort of seigniorage revenue from this privilege of being able to print these IOUs and sell them at higher prices, okay? We're gonna use Arvind and Annette's sort of estimates of these convenience yields. They get those from comparing Treasury yields to AAA bonds and commercial paper. We're gonna maturity weight these. And on average, you get about 60 basis points, which is not negligible, but the seigniorage revenue is too small as a fraction of GDP. So it's about 0.2% of GDP. That's not gonna really tilt the scale here, okay? So if you add that back, you actually do get a smaller puzzle, but it doesn't go much further in terms of closing the gap. One thing to realize is that there is an offsetting force when you do this. This is something that we originally hadn't thought about, which is that when you have big convenience yields, you're also saying that the actual real risk-free rate is much higher than you think it is, okay? And that actually pushes in the other direction. So if you're kind of wondering, well, why doesn't that red line move up more? Initially, we thought it did. That's why. Okay. So the one last sort of big theme that I want to hit upon is, well, what if we're just sort of looking at a historical sample where the US government hasn't been forced to make a big fiscal adjustment and we're kind of extrapolating from that? So what if investors sort of expect a big fiscal correction? Okay, so here we're going to use a big bazooka. We're going to let the government cut to 8% of US GDP in spending. Okay, so that's 2 standard deviations. As a benchmark, average spending to GDP is 11.5%. So we're going to subtract 8% from that and bring it down to 3.5%. So that is radical. You know, that's when, of course, if the government were actually to do that, that's when the pitchforks would come out, right? This is a radical experiment. How large would the probability, the perceived probability of this happening have to be to close the gap? You can just solve for that. And what you see is that initially the probability would have to be sort of reasonably small, but since the 80s, it's sort of been consistently trending upwards. This is obviously not consistent with rational expectations. It seems like agents are continuously anticipating a large fiscal adjustment that just doesn't happen, right? Okay. So let me sort of wrap up and conclude. As I said, it's a bit of a head scratcher. There seems to be a bubble in Treasury markets. Our approach quantifies the size of the bubble, and it's really large. Bond markets don't seem to be enforcing the transversality condition, and perhaps limits to arbitrage could contribute to that. Bond traders refer to shorting Treasuries as a widowmaker trade in Japan, and the same could be true in the US, okay? And so the question that we ask is, well, where have all the bond market vigilantes gone? The bond market vigilantes is a phrase that James Carville, who was a member of the Clinton administration, sort of coined when he was advising Clinton in the late 90s. That's actually when bond markets started to discipline the US government, and it was forced to run large surpluses for a short while because real interest rate went up. And so Carville famously said that he used to think that he were reincarnated, he wanted to come back as a famous baseball player, but after that he said, no, I want to come back as the bond market. It seems like the bond market hasn't been disciplining the US fiscal government, okay? And I want to leave you with a couple of thoughts. So contributing factors could be, well, it could be that convenience yields really are much larger than we think they are, okay? And there's some reason to believe that this could be part of the issue. When we're using conventional estimates of the convenience yield, we're looking at dollar-denominated assets, safe assets, on the left-hand side and the right-hand side, right? We're comparing Treasuries to, say, AAA bonds, but it could be that we're subtracting out a substantial convenience yields. And I've got some other work with Zhengyang that actually looks at that, and with Arvind, from the perspective of foreigners. And there we actually get much larger convenience yields. That could be part of the answer to this puzzle. It could also be, let's face it, that the Fed has been distorting yields. By the way, if you look, for example, in 2009, you add up what the Fed and what foreigners were holding as a fraction of the total supply of treasuries, that number was about 70%. So it's really sizable. Okay. And to conclude, I want to go back to where we started, right? I started with this sort of provocative quote from Blanchard, who said, the government can just probably keep rolling over debt. There's no issue with that. Okay. So the first point we want to make is, let's be clear, the right discount rate is much higher than G. Okay. If not, you wouldn't be able to price this claim, because this claim is actually pretty risky, a claim to surpluses. Now, it could be that the return on treasuries actually is low because there's a big convenience yield. That's possible. But of course, if you read Arvind's work with Annette and the work of others, you realize if you keep issuing IOUs, at some point, the lambda goes to zero. There's a downward sloping demand curve for safe assets, right? And so this is not something you can keep exploiting. When that happens, the US will become like any other country that has to actually implement pro-cyclical fiscal policy to make the debt claim safe. That would mean raising taxes in bad times. Okay. And actually, there's some interesting parallels in history. If you go back to before the First World War, the key supplier of the world's safe asset was the UK. Okay. Now, of course, to finance the war effort, the UK was forced to flood the market with safe assets. It actually lost its status as supplier of safe assets after World War I, and you can sort of see this because interest rates were actually much higher afterwards than before. Interestingly, the UK actually was forced to default on its 5% World War I bond. It converted it into a 3.5% bond, even though when it was marketing these bonds in the First World War, it famously said, its slogan was, this was sort of the advertising, if you cannot fight, you can help your country by investing all you can in 5% exchequer bonds. Unlike the soldier, the investor runs no risk. So these bonds were converted into 3.5% bonds. There's some dispute about whether this was a default because the conversion was voluntary, quote unquote, and apparently 90% of holders actually decided to convert. So question on the table then is, well, is the COVID-19 crisis for the US potentially our version of World War I, where we drive these convenience yields to zero? Okay, I'm about out of time, so I'm just gonna summarize real quickly and hand it back to Lars. If you price all treasuries, not just individual treasuries, you actually get a lot of interesting restrictions that have bite. And I encourage all of you to think about this. We think we're just scratching the surface here. Our conclusion is that bond yields are actually puzzlingly low, especially recently. Conventional estimates of the convenience yield don't fix this. And so it could be either that investors are incredibly optimistic, but it could also be the case that they fail to enforce the no bubble condition. And then the last option that I think we need to examine more carefully is that convenience yields are really much larger than we think they are. Thank you for listening.
Thank you, Hanno, for a great presentation, super interesting paper. We're now moving into the Q&A part of the program. And so we are going to, it's been a very lively chat discussion, very interesting. We're going to take some answers. You can raise your hand, use the raise hand feature in Zoom. And we're going to also call on some people in the chat potentially. I want to start out with Greg Duffy from Johns Hopkins.
Why, thank you, Lars. If you had written this paper about a corporation, you wouldn't be thinking, oh, it's a violation of a transversality condition, or it's like a convenience yield. We'd say, oh, this is a corporation that decided to go from low leverage to high leverage. Why isn't that a possible interpretation of what's going on with the US?
Can I take a stab at that?
Go ahead.
So we actually have a companion paper where we sort of think about this delayed adjustment hypothesis, and it's preliminary, but I'd be happy to share it with Greg and with others who are interested. And what we show there is that if you sort of use leverage to keep delaying the adjustment, the implication has to be, in the absence of convenience yields, that every time leverage goes up, your tax policy has to become more countercyclical. So that beta of the tax claim has to become safer and safer and safer. And the only way you can do that is to eventually adjust your tax policy to actually have taxes go up as a fraction of GDP in a recession. Remember, you have to make sure that that tax claim is a lot safer. And as you keep increasing leverage, it has to become gradually safer and safer and safer. Okay, so that is not a sustainable strategy, and we sort of talk about that in our companion paper. But it's a good point, but I don't think that that's describing what's going on because there's no evidence that that's what the Treasury is doing, right? If that's what was happening, then the Treasury ought to be increasing tax rates right now.
All right. Next up is Jonathan Parker from MIT.
Thank you. So Hanno, this is just a quick, so what I kind of have to believe is either that there's some mispricing in this market, investors are asleep or thinking past returns are a guarantee of future performance, or that sort of in the really bad state at the end, this is sort of what you just started to talk about, in the bad states of the world, what's going to happen is that the government's going to get its act together and satisfy the bonds, not the other claimants on the US funds, you know, the beneficiaries of all of the government programs and the like. They're going to raise taxes, they're going to cut spending. And so that's kind of what you're telling us, is that the market still has an extreme faith in the end game, where the government works it out and in the bad state satisfies the bondholders rather than the Social Security recipients, for example. Is that the right interpretation of this paper?
Yes, I think so. I don't want to let my co-authors weigh in, but let me just quickly say. And this,
can I just say?
Please.
So if we look at the bad states, and that by that I mean like Illinois, there's a huge pressure there to rewrite the Constitution so that they can default on the public sector retirees rather than the bondholders.
Right. Although I think the evidence by and large suggests that up until now, pensioners have been protected.
Yeah, they have, but that's because they're constitutionally protected, and they're trying to change the Constitution. Yeah. They're raising sales tax revenues. They're doing everything they can not to default on the bondholders. So it kind of looks like that end game is you're just thinking the current politicians are morons, and if I hold on bonds, I'll get covered even when the city goes under. Right.
That's exactly right. I want to let my co-authors weigh in, but let me briefly say that, as Jonathan put it, what you have to believe is that in very high marginal utility states, and presumably we're getting close to a state like that, the government would all of a sudden be able to generate big primary surpluses, right? That is what you need. Under Q, you really need to boost the value of the market value of debt by having these high marginal utility states where you get high primary surplus. Historically, we've just not observed that at all, but that is what you would have to believe in order to fix this puzzle. And maybe my co-authors want to weigh in here as well.
I would just add that in other countries like in Argentina or even in Italy today, you do see that CDS spreads, for example, have doubled in the last few weeks, kind of in response to this deterioration in the surplus claim. So I think the US, for now, has been kind of the exception to the rule.
Thank you.
All right. Thank you, Jonathan. I'm going to pull in from the chat. There's a number of interesting chat questions, and so we're going to go to Patrick Augustin from McGill.
Well, yeah, thanks, Hanno, for kind of a great talk. So I just have a quick question because it's a nice analogy to look at the CDS market, where we have seen that spreads have also been quite low. And even though they have kind of gone up a little bit due to the COVID crisis, they kind of still have been fluctuating below 20 basis points. And you see also in terms of insurance positions, right, that essentially the net positions have not really moved much in terms of people kind of buying insurance against US sovereign default. So I was just thinking in terms of the model that Mike has with Lucas and Andres, where kind of these spreads have to be rationalized through an interplay of monetary policy and fiscal policy. And I would have to think a bit more about this, but I was just wondering whether we could kind of draw any analogy with respect to that to rationalize this. Because in the US, we do have this question for monetary policy versus in Italy, in response kind of to the argument that Stijn made, or kind of the comparison, there's less flexibility on the monetary policy side.
Yeah, this is a terrific question, and we have been looking at CDS markets, and somewhere in mid-March, all of a sudden, all CDS spreads for non-emerging market countries like the US, started to move up. Of course, they went up much more for countries like peripheral countries like Italy and Spain. And I think what sort of really turned things around there was interventions by the Fed in the US and by the ECB. Remember, Christine Lagarde had made that remark, which I thought was sensible, where she said, well, it's not the job of the ECB to close all the spreads. Markets responded quite dramatically to that, and she immediately reversed herself the next day. And the ECB and the Fed engaged in massive programs, starting to buy bonds, and then you saw CDS spreads come down. So I do think that the support by the Fed and the ECB play an important role. As you point out, you can afford defaults and triggering CDS contracts by just, monetizing debt, but then it should show up in inflation expectations, obviously. And you don't really see it show up there either, so that is a bit of a head scratcher. How can you have sort of markets think that the Fed is going to and the ECB are going to fix this problem, but you don't see inflation expectations respond? So I do think interventions by monetary policymakers have had a big impact. If take an extreme example, in Japan, the Bank of Japan on its balance sheet has on the order of 1 GDP of government bonds. So those are not market rates anymore, I think. I think you sort of then have to think, well, these rates are essentially being dictated by the Bank of Japan. We're not quite there yet, but I do think that the Fed is distorting these prices, and that could contribute to the size of the puzzle. But what's tricky then is, is that inflation expectations, if you look at TIPS break-evens, don't seem to reflect that. I want to, but it's a great question. And by the way, I should have highlighted your work as well. I know that you worked on these issues as well. I don't know if my co-authors wanted to add something to this.
Yeah, I would like to add one thing. So going back to the theory results Hanno presented at the start of this seminar, it is actually quite general, the result of the equivalence between the present value of surpluses and the debt market value. This holds if the debt is nominal, real, risky, or defaultable. So we think merely having the possibility of defaultable debt is not enough to rationalize the gap between our estimate of the present value against the debt value.
Yeah, the other thing I would briefly add is that the gap has been widening for 40 years, right? So nothing in our theory says that the day of reckoning is nearby. This could keep going for a little bit longer. The other thing we know is from the post World War II episode is that about a third of the debt was paid down by inflation, about a third was paid down by growth. So presumably high growth for a long period of time and or a little bit higher inflation could pay back some of this debt. So if history is a guide, that might be in the cards as well.
Great, thank you so much. Next question is from Zhengyang Jiang from Minnesota.
So, yeah, I guess if you think of government as a price taker, to go to competitive equilibrium, there's no bubble condition that gives you this. If you think of a government as a non-trivial player who have strategic, think of a strategic, interactions between government and the private sector. There's a lot of game theoretic setup where belief about infinite future can sustain a lot of things that we cannot sustain in finite horizon settings. I guess what I'm saying is, you know, if we think, basically there's something, if we think of government as a strategic player, that bubble is not very, you know, it's not very surprising given some of the resulting game theory that we know. I guess I wouldn't say not surprising. I guess it could arise from some strategic interactions because there's an equilibrium belief about future.
Mm-hmm. I could take a stab at that. This is an important point, right? So we try to be very clear about this. We are imposing that no bubble condition, and there are, as Hengji points out, there are different classes of models that will generate in equilibrium and rational models violations of that transversality condition. Usually, though, if you have rational long-lived investors, that actually tends to do away with most of these violations of these no bubble conditions. But I'd like to make a broader point here, which is, you know, if you're a U.S. taxpayer, do you want to really put your money on and sort of say, well, I think this is sustainable because we can write down models where these transversality conditions are violated? I think if you look sort of at the economic history, then what you see is that countries that have had unsustainable debt policies eventually are forced to either confront this by defaulting explicitly or by generating huge amounts of inflation. And there are not too many exceptions to this. So I think even a casual empiricism would sort of say that this doesn't bode well. Interestingly, Reinhardt and Rogoff, looking at all the numbers, conclude that there are only 6 countries in the world that have never defaulted. The US is one of them, but it's a very small club, actually. It's not the norm. I think it's more the exception if you take a broad historical perspective. But it's a good point, and we try to be very clear about it, that yes, we are imposing that condition. Mindy?
Yeah, I want to also add something, like for those strategic models you mentioned, there might be multiple equilibriums. And one of this equilibrium might be, at some point, they stop to believe that the chance of government can pay back is 100%, and the interest on those bonds will be very high. So those are not sustainable equilibrium in those models, maybe. Yeah.
Right.
All right. I'm going to move it along to the next question. We have Sri Santosh from Colorado at Boulder.
So, I mean, my question is I'm going to go back to one of your older papers that I like Hanno and Stijn. The wealth consumption ratio paper. You're kind of estimating that the stock. It seems that wealth is not, you know, in that paper you show that wealth is not stock market wealth, and so the consumption risk premium is quite low because it seems like the total wealth must be much higher when we think that risk premium have to be covariance with return on wealth. So your estimate is something like $3 million per capita wealth. This was in 2006. You know, who knows what it is now based on interest rates and stock market, but something in that order of magnitude times the population leads to about $1,000 trillion of total U.S. wealth. So $20 trillion of debt is a de minimis amount compared to total wealth. So I think Martin was saying earlier about, you know, we see historically how much has been expropriated and not how much could be expropriated. So, you know, the entire U.S. debt is 2% of your estimate of the wealth of the nation. So it's perfectly plausible that if, you know, since the Constitution requires repayment of debt, that when the time comes that you can't continue to roll over, you put a 1% wealth tax per year for 3 years and you paid off everything.
Right. So that's an excellent point. And actually, we should go back to our estimates of wealth in that other paper. We hadn't done that. So thanks for bringing that up. And it's also good to force people to be intertemporally consistent. I think my answer would be, and this goes back to what I was telling Jonathan as well earlier, is that it's not enough to generate surpluses at some point. I think to fix the problem that we described, you really need to generate large surpluses in these disaster states of the world where marginal utility growth is extremely high. And I think if you look at democracies around the world, what you find is that democratically elected governments find it exceedingly hard, even when there's a gun to their head, to start generating primary surpluses in really bad times. Take the experience of Greece, for example. I think that's just one example to show that when people are suffering, it's not that easy to clean up your act and start running surpluses, and that is what it would be needed, really. So it wouldn't necessarily be enough to just run big surpluses, but you'd have to do it, I think, in really bad times, and that is where I'm not quite as hopeful as you are.
If I could just maybe add one little thing to that, which is that it's in general just pretty hard to generate a lot of tax revenue, right? So we know a lot of European countries are generating maybe twice the amount of tax revenue to GDP than the US is. Mm-hmm. But at some point you get on the wrong side of the Laffer curve, and there's kind of rampant tax evasion, and it becomes, there's basically tax migration, and people do everything they can to basically, not pay that type of taxes that would be needed. So, I think you make a good point. And maybe a wealth tax might be a potential solution, but there's clearly a lot of political resistance to that, especially in the United States.
All right, thank you. Next question, let's go to Wenhao Li from USC.
Hello, can you hear me?
Yeah.
Yeah, okay. So actually, it's kind of partially answered. So from the results we have seen so far, it seems there are several possibilities. One is violation of the no bubble conditions, which we have talked about. The second one, raise taxation. The third one, to monetize the treasuries. But so far from what we have talked about, it seems neither one of these is feasible or that plausible. So how do you think is a way out to solve this puzzle?
So I want to give my co-authors a chance to speak to this as well, but I do think that we have to confront the possibility that convenience yields are really much larger for the US than we think they are, and that actually the true real interest rates are quite a bit higher than we think they are. That might be an uncomfortable notion, but that's certainly what this evidence pushes me towards. I don't think that would explain the entire puzzle, but I think that would go some way, some part of the way to explaining it. Foreign investors have coordinated on picking the US as a supplier of the world's safe asset. Now, that is a huge source of seniorage revenue, and it could just be that we've underestimated how big that is, and that's what allows the US and maybe a few other countries like Germany to sort of escape from this strict trade-off that Miller-Modigliani logic dictates between insuring bondholders and taxpayers. But I think we need to do a lot more work to understand this. The key point there is, and that's sort of the answer to Blanchard, is that, well, demand for safe assets is downward sloping. So it is not true that you could just say, well, now T-bill rates are very low, so we could just keep doing this, right? If that's what it is, then I think we should be very concerned. And the UK experience speaks to that, I think.
Right. I would just add, so I may be a little bit less optimistic on the convenience yield explanation as the panacea to this puzzle. Although I do think, the last thing Hanno said, I certainly agree with that. Eventually, you've issued so much safe debt that it ceases to become special, right? So one exercise we do in the paper, this is actually to answer one of the questions in the chat as well, is to back out what would the convenience yield have to be to basically solve the puzzle. And what we find is that the seniorage revenue from convenience would have to be about 40% of total tax revenue. Right now, it's an order of magnitude smaller, right? So it would have to be like 10 times larger than it is today to reconcile the puzzle. And I'm not sure, you can get there.
So I also want to follow up on the analogy between the government and the corporations. So when you price the riskiness of the US government and you use the covariance between the tax income and also government spending with the SDF. But suppose, there are several equity cushions for the US government. One is the ability to tax in the future, and the other is the monetization of the U.S. Treasury, so which is basically a monetary power. Now, if you think about those equity cushions, actually the riskiness of the U.S. government might be reduced. So I wonder how large that part it is, and whether it's possible to reconcile the puzzle.
Yeah, that's a good point, Wenhao. I mean, I think, you know, and sort of we've had this comment quite a bit. It's sort of, well, we could just increase taxes and fix this problem, but the point is that you'd have to have a large fiscal adjustment. We showed you the exercise where the government cuts spending by 8% of GDP. That would be enormously painful. You'd have to do it at times when people are suffering. Conversely, you could think about an exercise where the government increases taxes as a fraction of GDP by roughly the same number. I think that would be a huge challenge to implement for a democratically elected government in times like this. So that is why, and also just looking at the historical experience, there aren't too many examples of countries that are able to all of a sudden generate these big primary surpluses in these types of conditions. So in principle, yes, the government has the power to tax the federal government. And it's true that there is always a tax rate that fixes the problem. But based on the historical record, that doesn't seem likely to us to be able to sort of close the gap.
And maybe add one small point on the inflation channel, right? So there, I guess the point is that the duration of US debt is only like 4 years, a little bit lower. So, you know, you would actually need a massive amount of persistent surprise inflation. And even that wouldn't get you very, very far in terms of resolving this puzzle. So that's kind of the other, the other aspect.
Yeah, for example, in other countries like the UK, the duration is much higher. It's closer to 10 years, or at least 8 or 9. So they would get a much bigger kick from persistent increases in inflation than we would.
Okay, thank you. We have time for one quick question. We have a PhD student asking a question, which is great. This is Zhuan Wang from Oxford. Please go on, Zhuan.
Hello.
Hello.
Yep, we can hear you.
Hi. Actually, I think my question was largely addressed during the chat. I was asking about the specialness of the US currency, and also how the paper relates to the safe asset. So I think the paper largely addresses the convenience yield, and the question focuses on whether that can uncover some of the puzzles. And another thing that pops up in my head is to what extent would you expect some other structural factors such as aging population and income inequality affects the estimation results, because that would have some effect on the equilibrium interest rate. Thank you.
Right. So that's the demographics question is a really good question. I'd have to think a little bit about how those secular low frequency changes would show up in a dynamic term structure model like the one we use. I think the model, the way we've set it up, is not equipped to deal with those types of changes. I think we have to write down an equilibrium model that is more structural in nature to be able to address that carefully.
One thing I would say though is that just the Social Security Administration's deficit over the next 10 years is going to add about 10 percentage points of GDP. So, you know, all else equal, just the debt is going to go up by another 10 percentage points of GDP over the next 10 years just from the demographics in the United States. So that's going to make the puzzle deeper.
All right. Thank you so much, everybody. We are out of time. Thank you, Hanno and co-authors, for a wonderful presentation and a really interesting paper. I hope you all will join us next week. We got Arvind Krishnamurthy, also from Stanford, who's going to talk. And so that should be super interesting as well. So thank you, everybody, and see you in a week's time.